Welcome to the Deep Dive. We're the show that tries to cut through all the noise and really just deliver the key insights from interesting new research.
That's the plan.
And today, we are tackling an absolute giant, Warren Buffett. For decades, everyone sort of looked at his success, especially if you're a new investor starting out, and asked, right, is this just pure genius you can never copy? Or is there something more systematic going on, something maybe replicable?
Yeah, and that's exactly what we want to dig into today. This one is really for you, the investor, who's maybe newer to this, trying to understand what really drives market success.
Right.
Let's pull out the most important bits from some pretty rigorous academic work that really tries to demystify Buffett.
Demystify, I like that.
Yeah, the goal isn't to, knock his achievements. They're incredible.
Hmm.
But it's more about turning this, secret formula into insights you can actually use,
Yeah.
something accessible for your journey.
Okay, so how are we doing that? What are the sources?
We're leaning mainly on a couple of key academic papers. One's called Demystifying Buffett, Factor Investing in Cheap Leverage, and the other is Buffett's Alpha.
Okay.
They're both by Andre Frazzini, David Kabiller, and Lasahi Che Patterson. Came out around 2018, 2019.
And these aren't just like opinion pieces?
No, not at all. They're deep dives themselves, really crunching the numbers, analyzing his actual investment records over decades.
Got it. So before we get into the how, maybe just remind us quantitatively just how good is Buffett's record?
It's genuinely in a class of its own. Let's use their numbers. If you put just $1 into Berkshire Hathaway back in October 1976,
Okay, $1.
by March 2017, that dollar would have become, wait for it, over $3,585.
Whoa. Okay, hold on. 3,600 times.
Yep, not a typo. Over 3,500 times your money.
Wow. That's not just good. That's sustained performance that's almost hard to comprehend. Really puts it in perspective.
Exactly. And in annual terms, that works out to an average annual return of 18.6% above the risk-free rate, the T-bill rate.
18.6% above risk-free.
Yeah. Now compare that to the general stock market over the same time. The market averaged about 7.5% excess return.
So he more than doubled the market's extra return year after year for decades.
Pretty much.
Okay, that sounds like magic, pure magic.
Well, and it gets maybe even more impressive when you look at risk-adjusted returns. The Sharpe ratio.
Right, how much bang for your buck in terms of risk?
Exactly. Berkshire Sharpe ratio over that 76 to 2017 period was 0.79. The overall stock market, 0.49.
So nearly double the return for the risk taken.
And here's the kicker. The researchers looked at all U.S. stocks, all mutual funds, with at least a 40-year history.
Yeah.
Berkshire had the highest Sharpe ratio, period, and the highest information ratio, too, which measures consistency. So basically, if you had a time machine back to 76,
Berkshire was the one pick, literally the best.
you got it, top of the list.
Okay, so let's unpack this then. Because, like you said, the story around Buffett has always been sort of mystical, this untouchable genius thing.
Right.
But these papers, they argue it's not just luck or magic. They say it can be systematically explained. So what is the secret sauce they found? What can you, as a newer investor, actually learn from this?
Yeah, this is the crucial part for anyone starting out. The research really points to two main pillars driving his success.
Two pillars, okay.
And yeah, he applied them with amazing skill and, importantly, conviction. But the underlying ideas, they line up with investment factors we can actually identify.
Oh, okay.
The first pillar is his investment style, what the papers call the Buffett factor.
Red Buffett factors. Okay, tell me about those. How can you spot what he looks for?
So when they broke down the kinds of stocks Berkshire buys, three main things kept popping up consistently.
Okay, three things.
First, he buys stocks that are cheap.
Yeah.
This is classic value investing.
Right, like Graham and Dodd.
Exactly. Companies with a high book-to-market ratio. Basically, their assets look valuable compared to their stock price. Suggests they might be undervalued.
Makes sense. Like his quote about socks and stocks. Buy quality when it's marked down.
Precisely. He wants a bargain on solid stuff. Second, he likes safe stocks.
Safe.
Meaning?
Low beta. Low volatility. Beta just means how much a stock moves with the market. Low beta means less wild swings. More stable.
Okay, so avoiding the super risky bets.
Yeah. This fits with something called the betting against beta factor, or BAB, the idea that, surprisingly, lower risk stocks can actually outperform riskier ones long term.
Interesting. Okay, so cheap and safe. What's the third?
Third is high quality. He wants really good companies.
Quality meaning profitable, stable.
Exactly. Profitable, stable, growing consistently, often paying out dividends, high payout ratios. This gets captured by the quality minus junk factor, or QMJ.
QMJ, got it.
So yeah, these are academic terms, BAB, QMJ. But for you, the listener, just think. He systematically picks companies that are cheap, low risk, and high quality. Okay, so buying good companies at good prices that aren't too jumpy. I mean, that sounds like common sense, right? Solid strategy.
It does sound like common sense now, maybe.
But how does finding these factors, like, demystify his returns? Does it somehow take away from his genius?
That's the really fascinating part, especially for you listening. When the researchers specifically controlled for these factors, value, low volatility, BAB, quality, QMJ, in their analysis of Berkshire's public stocks.
Yeah, what happened?
Buffett's alpha, the extra return that isn't explained by the market or these known factors, it basically disappeared. It became statistically insignificant.
Wow. So once you account for the types of stocks he consistently buys, his individual stock-picking magic sort of vanishes in the data.
Pretty much. It implies that a huge chunk of his outperformance from picking stocks comes from systematically choosing stocks with these specific characteristics.
So it's not that he finds some secret stock nobody else sees. It's more about the discipline, the consistency of applying these principles over and over.
Exactly. That seemed to be a huge part of it. And that's the key takeaway for you. These Buffett factor traits, cheap, safe, quality secrets, they aren't unique secrets. They are observable, widely applicable characteristics.
So you can look for these things, too, when you're evaluating your own potential investments.
Right. Whether it's individual stocks or maybe even funds that focus on these factors, it gives you a framework, a proven one.
Okay, that makes a lot of sense. Pillar 1, the factors. But you said there were 2 pillars.
Yes.
The sources also hammer home this other element, one that's often overlooked, leverage.
Yes. Leverage.
Which, can be rocket fuel, but also dynamite. It boosts gains and losses. How did Buffett use leverage so well? And maybe more importantly, how did he get it so cheaply? Because that seems key.
It is key. And this is a really distinctive part of the Berkshire story. It's honestly why his overall results are so hard for an average person to fully replicate.
Okay.
The research estimates his average leverage is about 1.7 to 1.
Meaning for every dollar of Berkshire's own money, he's investing about $1.70 borrowed.
Roughly, yeah. And you're absolutely right. That magnifies everything. The returns, but also the risk.
So the crucial bit isn't just that he used leverage, but the cost of it must have been different, right? Because borrowing money usually costs quite a bit.
Exactly. This is where it gets really interesting. The cost was remarkably, almost unbelievably low. His main source, insurance float.
Float. Okay, explain that simply.
Sure. So insurance companies collect premiums from customers up front, right?
Yeah, you pay your premium first.
But they only pay out claims later, sometimes much later. In the meantime, they hold on to all that premium money. That pool of cash they hold is the float.
Ah, okay. So it's money they hold but haven't paid out yet.
Correct. And Berkshire, being a massive insurance conglomerate, has a huge amount of this float. It essentially acts like a loan to Berkshire.
A loan? But what's the interest rate?
That's the amazing part. The estimated average annual cost of this float over that long period, only 1.72%.
1.7%. That's incredibly low.
It gets better. That 1.72% was about 3 percentage points below the average T-bill rate at the time.
Wait, below? So they were effectively getting paid to hold this money, negative cost capital?
Sometimes, yes. Essentially free, or even better than free, capital to invest. And this float makes up a huge chunk of Berkshire's liabilities, like 35% or so.
That is just a massive, massive advantage.
Huge. And it wasn't the only source of cheap financing.
Oh, what else?
Things like deferred tax liabilities. Because of rules about depreciation, they could delay paying some taxes, effectively getting an interest-free loan from the government in the meantime.
Another interest-free loan. Okay.
And also some complex stuff with derivatives, where Buffett essentially sold options, supplying leverage to others who were willing to pay a premium for it because he himself had access to such cheap, stable funding.
Okay, so for you, the listener, the message here is pretty clear. This access to incredibly cheap, stable, long-term financing. That's a major piece of the puzzle that's almost impossible for an individual investor to copy directly.
That's a really key distinction, yes. It's not magic, but it is brilliant financial engineering combined with the insurance business structure.
Yeah.
It's not something you or I can just go out and get.
Right. Okay, so this is where it really starts to click, I think, especially for someone figuring out their own strategy. If we put these 2 pillars together, 1, consistently buying cheap, safe, high-quality stocks. 2, applying smart, cheap leverage. What does this actually mean for you and your investment journey? How much of this can actually be systematically replicated?
This is where the research gets really practical for new investors. The academics actually went and created what they call systematic Buffett-style portfolios,
Okay, simulated portfolio.
designed to mimic his market exposure and those factor themes: cheap, safe, quality. And then they applied leverage, similar to Berkshire's level.
How did they do?
They performed remarkably similar to Berkshire Hathaway itself.
Seriously.
Yeah. In fact, sometimes these systematic diversified portfolios even beat Buffett's actual public stock portfolio returns, probably due to diversification benefits. A broad systematic portfolio is naturally more diversified than even a brilliant manager's concentrated picks.
So a diversified strategy built on his core principles plus leverage could potentially match or even slightly beat his stock returns.
Wow. Okay, so if his stock picking is so tied to these systematic factors,
Yeah.
does that diminish the genius label? Or is the genius maybe in seeing it first
Yeah.
and sticking with it?
I think that's exactly it. His genius isn't just about the factors themselves, maybe. It's recognizing them decades ago, finding that unique way to get cheap leverage, and crucially, having the ironclad conviction to stick with it for decades, through thick and thin.
Right.
That's where the discipline comes in. Remember his own quote, something like, in investing, it's not necessary to do extraordinary things to get extraordinary results.
Yeah, echoing his teachers, Graham and Dodd.
Right. The genius might be less about some secret formula and more about the disciplined, consistent application of what works, especially when it's unpopular. Okay, that makes sense. And this also leads to something important for you listening, right? Setting realistic expectations.
Absolutely.
Buffett got that amazing 0.79 Sharpe day ratio, which is fantastic, but as you said, maybe not superhuman like some marketing claims you see.
Exactly. Some asset managers might throw around targets of Sharpe-Bayes ratios over 1, even 2.
Which sound incredible, but maybe aren't realistic long-term.
Often not, or they come with hidden risks. Buffett's 0.79 achieved over decades is world-beating, but it perhaps represents the upper end of what a really well-executed systematic leverage strategy might achieve.
So for you, instead of chasing those maybe unrealistic pie-in-the-sky numbers,
A more realistic but still ambitious long-term goal might be aiming for a Sharpe ratio somewhere between the market's historical average, maybe around 0.5, and Buffett's territory, maybe closer to that 0.7 or 0.8.
setting achievable targets, that helps you avoid making bad decisions chasing impossible returns.
Precisely. It helps you focus on a sound process rather than just headline numbers. Temper expectations, but aim high within realistic bounds.
Very practical. Okay, so any final key takeaway for new investors from all this? How can you use this?
I think the big one is consider embracing factor investing, or smart beta as it's sometimes called.
Because so much of his stock success ties back to those systematic factors?
Yeah. Value quality, low volatility. Instead of trying to perfectly guess Buffett's next stock pick, which is hard, he has private holdings, scale advantages.
Right.
You can look for diversified portfolios, maybe ETFs, that are specifically designed to give you exposure to those same factors.
Right.
It's a way to systematically tap into the underlying drivers of his success without needing his specific genius or his unique, cheap leverage.
So the magic might be explainable, but the lessons learned are still incredibly valuable.
Absolutely. Still incredibly powerful.
Okay, so let's wrap this up. Big picture for you, the listener, maybe just starting out or refining your approach. What's the ultimate nugget from demystifying Buffett?
I'd say the core insight is that his incredible success isn't really magic. It boils down to a powerful mix. One, that systematic disciplined focus on cheap, safe, quality stocks. And two, the unique and brilliant use of extremely cheap leverage over the very long haul.
Right.
Remembering those two pillars, the factors in the smart leverage, can give you a really solid framework for thinking about your own investment strategy.
Definitely food for thought. And maybe a final provocative thought for you to chew on.
Okay.
While this research breaks down his returns into factors and leverage, which sounds very replicable in theory, it doesn't diminish the man's achievement at all, does it?
Not in the slightest.
Think about it. He started doing this decades before these academics even named the factors. He engineered that cheap leverage system, and maybe most importantly, he had the sheer conviction, the guts to stick with it.
Yeah, that conviction is key.
Like, remember the late 90s tech boom? Berkshire famously underperformed massively, lost something like 44% of its value between 98 and 2000, while tech stocks soared.
Right when everyone else was chasing tech.
Exactly. Most people would have panicked, changed strategy, rethought and retreated, as the paper put it. He didn't.
But stuck to his knitting.
He did. So for you, the investor listening, maybe the ultimate question isn't just what factors to invest in, but how will you develop the discipline, the conviction, the emotional resilience to actually stick to a sound strategy when times get tough, when the market makes you doubt everything?
That psychological fortitude.
Maybe that's the part of the Buffett magic that's hardest to replicate. Something to think about.